On June 12, 2026, Elon Musk did something no one thought possible. He took SpaceX public at a $1.75 trillion valuation. The stock jumped 19% on day one. And regular people like you and me? We couldn't even buy shares. Here's what really happened and why it matters for your money. Meet Sarah. She's 32, works as a nurse in Ohio, and has been investing $200 a month in index funds for 5 years. When she heard about the SpaceX IPO, she got excited. She'd been following SpaceX for years. She watched every rocket launch on YouTube. She thought, this is my chance to get in early on something big. So she opened her brokerage app, searched for SpaceX, and tried to buy shares. But something was wrong. The IPO was already oversubscribed by over $70 billion in retail orders alone. Her broker told her, allocation is limited. You might get nothing. Sarah stared at her screen. She'd waited years for this moment. And the door was closed. Here's what most people don't understand about IPOs. An initial public offering isn't just a company selling stock. It's a carefully controlled event where the company and its banks decide who gets rich. SpaceX offered 555.6 million shares at $135 each. That raised $75 billion, one of the largest IPOs in history. But here's the thing. SpaceX's revenue in 2025 was $18.7 billion. That's impressive. Up 33% from the year before. Starlink alone has over 4 million subscribers beaming internet from space. But let's do the math. At a $1.75 trillion valuation, SpaceX is trading at roughly 93 times its annual revenue. For comparison, Apple trades at about 8 times revenue. Tesla trades at about 12 times revenue. So why would anyone pay 93 times revenue for SpaceX? Because they're not buying the company. They're buying the dream. But that's only half the story. Because here's where it gets serious. When you buy a share of SpaceX, you're not buying control. Elon Musk controls approximately 85% of the voting rights. That means he decides everything. The direction. The strategy. The money. You're a passenger. Not a pilot. And the banks running this IPO, Morgan Stanley, Goldman Sachs, JP Morgan. They allocated the shares to their favorite clients first. Hedge funds. Billionaire friends. VIP accounts. Regular retail investors? They got whatever was left over. Over $70 billion in retail orders flooded in. Most of it went unfilled. As one analyst put it, this IPO was designed to make the right people richer. Everyone else gets to watch from the sidelines. That's not investing. That's a spectator sport. Now here's what wealthy people actually do that most people don't. They don't chase IPOs. They don't FOMO into the hottest stock of the year. They build wealth slowly, quietly, and consistently. A simple S&P 500 index fund has returned 10 to 12% annually over the past 20 years. That means your money doubles every 6 to 7 years. No hype. No drama. Meanwhile, studies show that most IPOs actually underperform the market in their first year. Why? Because the IPO price is set by the company and its banks. They're not trying to give you a bargain. They're trying to maximize their own money. What most people do, see a headline, get excited, throw money at the shiny thing. What wealthy people actually do, wait. Research. Invest in what they understand. And they never bet the house on a single stock, no matter how exciting it seems. So what should you actually do this week? 3 specific moves. Number 1, open a brokerage account if you don't have one already. Fidelity, Charles Schwab, or Vanguard. All 3 let you start with $0. Set up automatic investments. Even $50 a month into an S&P 500 index fund. Number 2, if you want exposure to space and tech, buy an ETF. The ARK Space Exploration ETF or the Vanguard Information Technology ETF. You get diversification. No single company risk. Number 3, write down your investment rules before you invest a single dollar. How much are you willing to lose? What's your time horizon? When will you sell? If you can't answer those 3 questions, you're not investing. You're gambling. Remember Sarah? The nurse from Ohio who couldn't get SpaceX shares? She did something smarter. She took that same $200 a month and put it into a low-cost index fund. No stress. No allocation anxiety. In 30 years, at a 10% average return, that $200 a month becomes over $450,000. She didn't need SpaceX. She needed patience. If this changed how you think about IPOs and investing, save this video. Share it with one person who needs to hear this. Subscribe. I break down complex money topics every week in plain English. See you in the next one.